Hi, good morning, and welcome to today's edition of the Market Analysis Pre-Market for today, Wednesday, the 7th, September 7th. I'm Giovanni Benacour, operator and educator with Vantage Markets. Well, let's begin. Let's highlight several variables that could send oil up or down by $5 to $20 a barrel. Let us begin by stating the obvious. A slate of supply and demand risks could make oil prices fluctuate dramatically, the foremost being a potential global recession. Manufacturing data suggests that a contraction in industrial activity is likely, which points to a downturn that could cut oil demand growth expectations by over 1 million barrels a day. That could send Brent towards $75. Similarly, in the event of a new Iran nuclear deal, prices could fall temporarily by as much as $15 a barrel as an extra 1 million barrels hit the market. But OPEC Plus will likely react swiftly, with other members taking some production out of the market. So, as oil being a key indicator, the U.S. benchmark oil price fell to lowest level since January 26, trading at about $85 a barrel. That is a significant retreat from the high seen after the Russian invasion of Ukraine in February, as it became clear the conflict won't shut down Russian oil output. A U.S.-led price cap on Russian crude could also sway prices, but Russia's energy minister said the nation will respond by shipping more crude to Asia. They said that any actions to impose a price cap will lead to deficit on initiating countries, on markets, and will increase price volatility, Nikolai Shulminov said at the Eastern Economic Forum, per Reuters. So the G7 finance ministers last week endorsed a plan to cap the sanctioned barrels as a way to minimize funding to Moscow's war machine, but Europe continues to take in huge amounts of Putin's supplies. Worldwide refiners have shed roughly 2 million barrels per day of crude distillation capacity compared to 2020-2021 due to shut-ins and underinvestment. This poses a challenge to OPEC Plus, as increasing crude oil supplies for refineries will worsen current imbalances, but at the same time, cutting supplies threatens to push prices even higher. The light-heavy differential, or the spread between light products like gasoline and diesel and heavy fuel oil, is a key measure for energy markets. However, a key bottleneck in this differential has emerged with threats to push OPEC Plus to slash output, which will then push oil prices higher. At the same time, natural gas prices are still high in Europe after Russia kept the Nord Stream pipeline closed. While natural gas prices in the U.S. have also risen, they won't spike in the same way because the U.S. is the biggest producer of the fuel. The U.S. is still exposed to swings in oil prices in the global market, even though it imports as much as it exports. The U.S. is set to conclude releases from the Strategic Petroleum Reserve in October, and with strategic inventories falling sharply over recent months, a gap in the market may emerge that could sway OPEC production. On the other front, the gas crisis in Europe could get even worse as winter approaches. European stocks may fall another 50% as energy price gains damage the economy. The drop in oil prices has already spurred OPEC to make a symbolic output cut by about 0.1% of global output, and it may consider more later in the year. On the equities front, to say that the markets got the message after Federal Reserve Chairman Jerome Powell's Jackson Hole speech is putting it mildly. Less than 2 weeks on, the S&P 500 is down 7% from its prior close, and for the Nasdaq, it's nearer 9%. With 2 weeks until the next interest rate decision, the Fed wants to make doubly sure investors know that curbing inflation is its number one priority. This gives way to thinking price pressure will come down a lot and stocks will rebound soon as demand slows. One sign of slowing demand comes from China, whose exports rose 7.1% in August, well below expectations. President Biden reportedly remains undecided on whether to ease tariffs on Chinese imports, which were imposed in 2018. This suggests their elimination could cut 1.3 percentage points from U.S. inflation over time. Falling prices reflect fears that the global economy is rapidly cooling, lowering demand for energy. Interest rates hikes by the Federal Reserve and COVID lockdowns in China are threatening to dramatically bring down growth. And as Europe's energy crisis rages on, more EU nations might start pivoting away from burning natural gas and instead try to lean into oil. That could lead to more demand for crude and so higher prices. However, this reflects the uncertainty of the times. Crude prices could either surge or crash more than 20% depending on how a smattering of risk unfold. Meanwhile, geopolitical uncertainty in Iraq and Libya threatens to push crude prices higher, and so also as China's potential reopening after stringent COVID-19 lockdowns. With that being said, let's take a look at what the markets have entitled for us today. Yesterday we saw that the markets did had a small rally at the beginning, but quickly gave those up, and it finally closed below our 12,000 psychological level, where we are trading right below it right now. I have an 11,920 support level, which most likely will be tested and perhaps broken, as the RSI is not yet in the oversold territory. The same token applies for the S&P 500. RSI not being in the oversold territory right now. Obviously we've been trading below the 4,000 level quite for a couple of days now. Now the 3,880 support, psychological support, is the one that we're setting our eyes on. The 3,900 is where is presently holding that support level. Natural prices of crude oil. Crude oil has finally broken that $86 psychological support level, trading right below that. We have our support level at 85. The RSI is still a ways from being oversold, so perhaps more selling pressure will come. Once we break that $85 psychological support level, then we're coming down to obviously our 84, and with that keeping it in mind, perhaps 80 will be the support level will be coming down towards by the end of the month. Let's see what happens. On the natural gas front, we have the $8 psychological support level that is market is really holding on to by cents. Once we break this support level, most likely we're going to come down and test our support of 760, which is our previous low of August, about a month away. So perhaps we'll come down towards a previous month low, and from here, obviously rebound again and make the same kind of movement towards the upside, towards that $10 movement. So keep that in mind. And especially because of what's happening with the Nord Stream 1 being indefinitely shut down until he finds the proper turbine, so he says. Anyhow, in regards to gold, we see gold how it has broken, or actually, guys, also really looking to trade below our 1,700 psychological support level. Once we do break this level, right now is being violated. We have that 1,690 as our psychological support level, which more likely will happen. Now our pivot is right above that as 1,705. Gold will definitely receive more selling pressure as the dollar index continues to rising. What has been giving us some sort of stability has been silver trading right above our psychological of $18 support level. Then we have copper. Copper really has been on a shred, coming down strongly, finding support right around the 3.36 cents level. We have obviously a pivot point at 3.44 that is acting as a resistance. So perhaps copper will come down to $3.40 and find some support right here, and then take another attempt at another high. But so far, the RSI is still not in oversold territory. Then we have Bitcoin that has really lost its track into the 20,000 mark, and then from there it plunged to 1850, 18,500, and where we have our fluctuating right now right above that. I have my $18,000 level, which is a strong support, psychological support level. Should we break this support, I'm looking at 17, 15,000, our next support level. And then we have the euro, which it's been trading below parity, and it most likely will stay here for a little while, as long as we have our dollar index as so strong, and the dollar index looking to stay strong. 111 is our resistance mark for the day. 1110, 110.500 will be obviously our psychological support, but I have my 110 as mark here. All right, guys, that's it. That's it for me today. Hopefully, you guys stay tuned, and I'll see you next time. Have a wonderful day.